Hello, good evening. Welcome to my channel, The Invisible Trader. If you like the videos, keep do sharing with others and like it. Now, this video is going to be entirely in English because few people ask me that they don't understand Hindi. So this video is going to be entirely in English, and this video is about freak trades. Okay, is the title. So we would do quite a bit of analysis and see whether actually NSE is doing something wrong or NSE is doing everything right. Okay, right. So we'll start with this. And this is the next video, which I promised you that I'll give you probably on Monday with a mean reversion video also. So that's another video that would be coming, that how margin rule is going to affect and what are the things that we need to take care, especially if you're an option seller. If you're an option buyer, it doesn't make any difference anyway. What is quantity freeze, how it is affecting brokers and retailers both, and how should you read the data, the derivative data that we used to read, because if you see in a couple of days back, the data is showing something and the market is moving in entirely different direction, right? So is there any changes that we need to do in reading the data analysis and pattern? Okay, so and then last one I will talk in the video. It doesn't matter. So today's video is not this. Today's video is what is freak trade, how to handle freak trade. Okay, to give you some of the examples, this was given in my group by people from various sources, right? How does a freak trade looks like? Okay, now if we look like freak trades, so the first freak trade, if you look at in this year, that happened in, I think, July around 5th this year. If we take Nifty, actually not Bank Nifty. So if we take Nifty, so the first freak trade that we have seen, which is by a very huge amount, was July 5th, if I'm not wrong, when market was open and it fell down really heavily. Yeah, this July 5th. And if you see here, if I go for a 5-minute time frame, I don't know whether it will show me. No, okay, doesn't matter. So you can go ahead and look at yourself this date. I'll anyway explain you how the freak trade happened, but let us see that how a freak trade looks like. So a freak trade looks like this, something like this, right? Where basically there is a huge difference between in markets high or low and the opening or closing. Okay, so that means you see generally a very high long tail, right? So this is how a freak trade looks like. And let's look at some of the samples. This is a very famous one that people might have seen when the freak trade first happened, right? People started complaining in Twitter. If you see, this is another freak trade, okay, where the high is 50. It went from 3 and it came back to 3, right? Then very recent one, if you see the 37,100p, where it went from 435 to 1921. I had actually, so we'll start with this reference because this is the very recent one. I had a trade on that day also, okay. And if we look at this, the trade, I'll tell you how the freak trade is basically gets formed, right? So if I go to a 5-minute time frame, and I was on the same trade, guys, okay. So if you see the candle difference between this and this, right? If you see, it's a gap down scenario ideally, okay. In a 5-minute time frame, it's a gap down scenario from here to here, okay. So how much of gap down? 36,950, and opening is here. 36,900, only 50 points gap down, okay. Only 50 points gap down, and let us say it move to the low of this 36,840. So we're talking about a 100 point, just a 100-point move in some milliseconds. If you go to 1 minute, you will see it more wonderfully what I'm trying to say. And then I'll tell you that why the freak trade will happen like this. Yeah, if you look at this candle, 949, opening is 36,900, low is 836. So from here to here, market just went how much of points? Bank Nifty only 100 points. Okay, my trade was here where I started selling. 37,000 P was my trade, and this was a 37,100 P. Okay, which went like 1500 points up with just this 100-point move. This is just a 100-point move, guys, right? Here the price should have been around 300, 350, something like that. Okay, now with this, just this with 100-point move, how market moved 1500 point plus, especially in this option, then in this strike, in this option, how it has moved 1500 point ups. So that's what we call freak trade. But let us understand why it happens first of all, right? Now if you look at why it happens, if I'll tell you guys, let me just take a screenshot and then try to explain here. Okay, yeah. So if you look at here, people, if they have bought, let's say for example, few people has basically sold 37,100 P because market was moving up. Okay, it's in the money P, but they sold it as market is moving up. Okay, to gain more money, to get more premium. Okay, now when the market is falling, let's say here the price was somewhere around. So let's say here the price, option price is somewhere around 370, let's say. Okay, and let's say here the price is somewhere around 450, somewhere around, let's say. Okay, and let's say buying price, selling price is around, let's say 420. Okay, so this is my 37,100 P. I'm just giving an example. Okay, 37,100 P. Okay, now the moment, what is the reason that triggers to go it from 450 to 1900 with just 100-point move? Very simple. First of all, what you need to understand is that how fast this candle has moved. In a 1 minute time frame, it doesn't look like that. But अगर आप live में ये candle को देखते, it was a sudden drop and gap down kind of candle. Okay, so whenever a gap down and gap up happens, I'll show you how the volatility increases and decreases. Because option prices, okay, option prices are derived from where? So there is a very simple question that people get confused, whether option premium is derived from volatility or is the vice versa. Okay, that means the volatility is derived from the option price. I hope you know the answer. Okay? I have discussed it in many times in the group that from where what is derived, right? So option premiums are basically if you look at, they are, people say that option premiums are generally derived from the underlying price movement. Of course it is there, but there are other option Greeks that we have. Most of them is basically Vega, right? And which is related to, some are related to volatility, right? And implied volatility and all those. So implied volatility is calculated from the option premium for sure, but the volatility, the absolute volatility definition, okay, ideally is not based on option premium. Rather, option premium is derived from the volatility. Okay, cool. So that means it really needs an analysis whether option premiums, there is a gap between option premium demand and supply or not. Okay, right. Now, if I consider these concepts and go, whenever the volatility increases, okay, whenever the volatility increases, the option premium is going to be more, provided that there is a demand and supply at some point, right? So if I close this, provided that there is a demand and supply at this level. So for example, let us take this level, 800 example, right? So when volatility increases, the price, the demand for the price will go up. It will go up. But The question is whether it will go up 800, it will go up 2000, it will go up 5000. We don't know. How that is derived, whether it will go, because here it is 800, right? And here it is, if you see, this is 1900, right? So how that is getting derived basically. So the question, answer to that question is basically the demand and supply at that price. Okay, because I also had a 37,000 P, if you see here, but that did not go to like 1900. It went up to maximum 600. It went. I have seen it, the highest is 634 it went. Okay, and I cut it somewhere 450 or something like that, whatever it is. So 420, 430, I cut it up. But the 37,000 P only went how much? It went up to 634 only high. Okay, so this is 37,000 P. But 1921 was the high for 37,100 P. Okay. Now you will get clear, because there is only 100 point strike price difference. But this went only 634. This went only 1921. It is the same volatility in the market. It is the same index, Bank Nifty. Okay. Then the question is why it did not go up to at least 1500. And that is the reason I said you need to understand the difference between option premium, though it is being derived from the volatility. Is there a demand that present on that price or not? Okay. I hope everybody is right now getting clear that how these highs are getting derived. Okay. I mean, there is at least a difference. At least you guys understand that there is a difference and it may not happen every time. Okay. Clear? Now, why it went to 1921 is very simple. That means somebody might have put a limit order here on option selling on 1921. Okay. So that means when market was coming down, somebody has put a limit order. Okay. Understand this very clearly. Somebody has put a sell limit order at 1921. ये blindly किया होगा उस किसी ने. Okay. Now, if let's say the volume is also important here. If let's say how much of volume, it might be possible there are only 1000 quantities. It might be possible there are only 2000 quantities. Might be possible there are 40,000 quantities. It might be possible there are 5 lakh quantities. It is all pure demand game. Okay, demand supply game. I told you that whether it is you need to identify based on demand supply. So what is demand? That how many people, that means how many quantities are sitting with a sell limit order at this price. Okay. How it is going to make a difference? The difference it is going to make is ideally that whether the price is coming down from ideally 1900 to 100 again or 400 again, or it is going to stay there, right? That is what it is going to make a difference depending upon the volume, right? To understand this more, guys, that why the candle price went, let's say up to, in this case, 800 and it came back to 100 again. So this is again pure demand supply, right? So if I come here and say, sorry, there is no escape coming, which is okay. What I'm saying is, let's say here are only 5,000 quantities that are trading at 800. Okay. So if basically the trade is closed and there is no other limit order in between this price till 100, then market will straight come down from 800 to 100 after executing this, because the next demand is at 100. That means the demand that has been created at the price band of 100, or a demand that has been created at a price band of 1921, they are temporary in nature. That means with low volume only. There might be high volume, but there would be, in this case, it is low volume. That means once this 1000, 2000 order got executed, market will come back to its original demand price, where most of the buyer and seller are fighting or trying to execute the order. Everybody is clear? Okay. Now, first of all, we discussed that somebody has put a sell limit order at 1921 at this price, for example. But why, why somebody, the guy who sold P here, right? Why his order got basically executed at 1921? Because somebody has to sell, right? And somebody has to buy. So the guy who sold here at 430, let's say, he was forced to buy at 1921. So that means a 1500 point plus loss as an option seller, right? Everybody is clear? Now, why he was forced to buy at 1921 when the price just stayed there for some milliseconds? Okay, you're seeing the candle like this, but it is ideally the orders are executed in less than second, even in some milliseconds, right? Now, why the guy was forced to do it? So there are two reasons why the guy would have forced to do it. One of the reason is, first of all, how much of money you have in your account. Okay, how much of money you have in account and how much you deployed in trading, in the current trading. Let's say he is doing only one trading. How much you have deployed one in current trading. The second thing is that the guy probably put it as a stop loss market order. Okay, SLM order. Okay, so these are the only two things because of which the trade gets executed. Now, if you see, if you have read a lot of brokers terms and condition, what they say, if there is volatility, we do not guarantee at what price your order will execute once the stop loss trigger price has been started. So let's say बंदे ने यहाँ पे क्या होगा, let's say 600 पे SLM लगाया होगा, 200 point का stop loss. Okay, only 200 point SLM. Stop loss market trigger price is 600. Now the trigger price is executed at 600, but the problem is there is no demand at 600. The demand is at actually 1921. Okay, here the demand is at 1921. So since there is no demand between 600 and 1921, market will go and execute your buy order with the demand price, which is 921. Okay, there is no value or the no price value at which people are ready to trade or order between 600 and 1921, let's say. Okay, and that is the reason whatever the first price it sees in a volatile market, it will go and execute your order. Okay, so that is the SLM order. Now, first thing is, let's say, even if you do not, now people will say, मैं stop loss put in नहीं करूँगा. That means I will not put any stop loss. For example, what is the behavior of rig trade? That market will go up and in within 1 second it will come down. That means if you're not putting your stop loss, correct, then also market will save you. That means, let's say I have not put my stop loss at 600. So that means my trigger price will not execute. Let market go to 1921, 2000, 5000, doesn't matter. Then you will ultimately come back to 100. So I'm at least not in loss. Freak trade is not going to affect, right? No, it doesn't happen like that. For there, the first line I have written here, that how much of money you have in account and how much you deployed in trading. So let's say we'll take an example. You have a account capital of, let's say, 1 lakh. Okay. Now you have put 80,000, let's say 80,000. That means you have bought, let's say, 20 lots. Okay. And 400 price. So it go around 80,000, let's say. Whatever lots it is. 80,000 ka deploy kiya aapne. Now you have only 20,000 rupees margin, extra cash in your account to handle any losses. Okay. So the moment it goes beyond the definition of the cash that is to be present to handle the extreme loss margin, right? Your broker will automatically square it off. Okay. Broker will square it off automatically. Even if you do not have, even if you have not put a stop loss market order. Everybody is clear? This is the second reason with which even if you do not put a stop loss market order, broker will go ahead and execute it. Okay, because they have to manage their stuff, because you don't know, because by machine definition, the broker doesn't know whether it will stop at 1921 or it will go up to 10,000. They don't know. So they have to be safe from their side. So they will go ahead and execute your order without your permission. Okay? This is like without your permission, but it is written in the terms and condition of the document. So you cannot claim anything. Hope everybody is clear. These are the two things that you need to keep in mind, and especially option sellers, if it is happening. Okay, if it is happening with you, it may happen, it will happen. Now I'll tell you why it happens, how the volatility, why volatility increase. I'll just show you one thing. If you see India VIX, you will see a lot of this kind of frict. Every candle in India VIX will look like freak candles. Can you see this India VIX? Every candle you see, right? In the morning. Why? Because in the morning the volatility is very high. And why it happens that in the morning the volatility is very high? There are two reasons. Either market gaps up or gap down, first thing, or it opens flat and moves like in within millisecond, it makes like 300-400 point move in Bank Nifty. There are only two reasons because of which this volatility gets created. And that is the reason in India VIX, every candle is a freak candle. Okay, that is just to make sure to understand how does the freak candles got formed. And that is the exact reason I told you the gap down scenario here within intraday. Okay, this is like a sudden drop. This is like a sudden drop, and the sudden drop actually triggers the movement based on this demand supply concept that we have seen, and based on the volume and price trade. Okay, volume and price concept. Okay, now if you're doing it manually, can it happen? Probably not. It happens because of high frequency trading. Okay, because of high frequency trading, that means when trades are being placed by system. Okay, and most of the derivatives trades are being by system. If you want to know more about high frequency trading and flash crash, you can actually look at the study. This guy Navinder Singh Sarao, who has actually triggered a flash trade in London Stock Exchange, UK Stock Exchange, okay, and was sentenced to jail because of that. Okay, where he forced the machines to basically do freak trades. Okay, that means do a flash crash. Okay, that was of course on the downside, and this you will see only mostly on the downside. The problem is here right now it is happening both the downside and upside. Don't know. I mean, you can see it in C, you can see it in P. Now the question that you can ask, why NSE is not doing anything on this? Is NSE is a culprit here? Of course, because whenever there is high volatility, okay, whenever there is high volatility, a stock exchange, what stock exchange does, it puts a limit. Okay, it puts a limit on the demand. That means it will say for 17,100 PE, when market is at this level, let's say, because there is a 300 point move downside or 300 point move on the upside, the maximum price option price that can go up to, let's say, 650. If a stock exchange will define that we will give you double, let's say straight, it's not exactly the same calculation, but from a layman point of view, we will give it double the price of the movement of the volatility moment. So it will not go beyond 600. Okay. Now the question is why NSE is not doing it. NSE used to do it before. They also have been doing it right now. The only thing that they have done is basically increase the band of this demand. Okay. They have increased the band of this demand. Okay. And I think I'm not sure, I need to see, but some people have complained, and there are some articles that people have written where they say NSE in some scripts, not all, in some scripts, okay, NSE does not have a band. I'm not sure. I'm not claiming. Don't screw me और मेरा YouTube वीडियो देख के NSE को complain करके don't put me into legal problem. I'm giving a disclaimer that I'm not sure about this. I need to verify, but some of the people are saying in some scripts, NSE does not have a band restriction. That means the price can go to anything. Okay. So, but what is the problem is the demand band is very broad in some of the scripts, like 37,100p. It was like almost how much 500% basically band increase, correct, right? NSE should not be doing that. Now people can ask, see, mostly the option sellers will sell, right? And this is whatever the discussion that we are discussing, it is basically a con for the option sellers. Now option sellers are generally HNIs and big brothers and all those people, right? So should retailers get happy saying that we are actually making HNIs and big brothers in loss because of this? Probably not. Probably not, because first of all, from my understanding, first of all, this 1921 prices that are getting executed, the volume concept that I have explained you a little bit before, the volume is very low for this kind of trades, and these volumes are generally retailer volumes, because most of the time the big brothers, they see where people have kept stop loss and all the stuff, so they manage their trade very easily. Okay. And there might be some days when the volume, I think there was one trade where the volume is around 6 lakhs. So in that case, a lot of HNIs and pros might have been in trouble, but most of the time I think it would be retailer in trouble rather than the HNIs, because there are retailers who basically sell anyway, hedged, naked, whatever it is, right? Correct. Now coming to that, it really doesn't matter to discuss NSE is helping whom or not. But I think from a ethical point of view, we should have the price bands restricted at some point. Okay, some numbers of volatility at least, so that basically price action works. Otherwise, NSE is going to have a reputation damage going forward. Should NSE be sued? Probably not, because this has already been covered in your terms and conditions. So you cannot go and sue and make any legal cases against NSE, because in the document it is covered that things like this can happen. Okay. Now we have discussed all the problems. What is the solution to this? Correct. Simple. The solution is very simple. It's just one solution to it. Okay. First of all, first of all, you need to make sure that you don't deploy more than 2% to 5% of your capital, which is a discipline, in any single trade. Okay. Otherwise, even if I give a solution, you remember I told you why broker will auto square off your stuff. If you don't maintain this, even if you give a solution, it's not going to work. Hope everybody is clear. Assuming that you are not deploying more than 2 to 5%, this is especially for option sellers. Okay. Option buyer, we don't have that much problem, because option buyer will like buy in a quantity, whatever quantity, but let's say you will buy, even if at the money, you will buy like 400 kind of stuff. Even if it goes down, it will go down like 200 points, right? Not more than that. 200 points you can easily manage. What you cannot manage is 2000 points. 2000 point move cannot be managed. 200 points can be managed. So this is not for option buyer. This is ideally for option sellers. So with this discipline, if you are trading, the solution to this is very simple. And the simple solution is that you have enough capital in your account. Whenever you have a position here in Zerodha or any other broker, you will get an option of basically exiting the trade, right? In that case, let's say you have sold it, then your exit trade will be a buy trade, right? So in this buy trade, if assuming that you have proper capital in your account, never go for an SLM trade. Okay, go for a limit trade. So let's say you have bought, I will take the 37,100p example. If you have sold it at 320, let's say, right, you put a limit order of 430. Okay, you put a limit order of 430. If you do this, then basically you might get saved. How you are going to get saved? For example, let us say here, okay, you sold it at 200. You put a limit order, let's say around 300 on your stop loss exit trade. Okay, when you make a exit trade, it is ideally that one. Now, what will happen? If there is a demand at 300 price, that means in exchange, if there are some trades which are getting executed at 300 price, your position will be squared up. You will be in loss. But the only thing that market will not take you to like 800 for sure. Okay. Second thing is, if it skips, since it is a 300 kind of limit order, if let's say it goes from 295 to straight 305 or 450 for whatever it is, okay, then your order anywhere is not going to execute it because it is not a stop loss market order. Okay, so it's a limit order, it's a stop loss limit order. So unless the price comes down to 300, you are not going to ideally the order will be executed. Now, when it went up to 800 and it comes to 300, there are two scenarios that will happen, right? Either there is a demand, for 300. Okay, that means somebody should have demand at 300. That means somebody should have put a sell limit order at 300 price. Correct? Agar hoga, then only it will execute and you will be in loss anyway. You will be in loss. And in that case, you will be in loss. Even the market skips it in the first time and it's coming back, and during that price somebody has put a order, then also you will get into loss, because while the market is coming, the value is coming down, it may not find a demand between 800 and 305, but it will find a demand at 305. So your order will get executed, you will be in loss. The only problem that here is you will be in 300 points loss, sorry, 200 point loss. Okay, but still then this loss would be less than your 1900 value loss if you are putting it on this stop loss market order. Clear? Here you know your losses, first of all. Okay, right? That is the one thing. Second thing is that if there is no demand at 300 price, then the price will come down to the next one. Let's say it's 100. That means you are actually managing your loss really, really well if you are putting a limit order. So rather than putting a stop loss limit order, try to put a basically stop loss market order. Try to put a stop loss limit order for your trade. That might save you better. I'm not saying that you will be saved every time, but that might save you better in the two different conditions that I talked about in terms of demand. Okay, the loss would be minimized. Okay, I hope everybody is clear, guys, based on this and what we are going to do. Thank you very much. Good night. Jai Mata Di. The next video I'll also put it in Monday.